Welcome back, everybody. We got a ton of requests to do a deep dive into how Warren Buffett invests, and we're going deep, like back to the 50s and 60s deep.
Before Berkshire, before the legend,
Exactly. We're cracking open his old partnership letters.
which are basically like,
Yeah, like annual reports.
yeah, to his early investors.
So we can see how his mind worked way back then, before all the fame. What were his strategies? How'd he pick companies? What even counted as success to him in those days?
Right, like what did winning look like?
Exactly.
Well, one thing that pops out immediately is just this like relentless focus on what he called undervalued situations.
Undervalued. So he wasn't chasing like the hot stocks of the moment or anything.
No, not at all. He was hunting for companies trading for way less than they were actually worth.
Okay, so how do you figure that out? Like, how do you even determine what a company's really worth? Was it just like gut feeling?
No, he had a method. So imagine you're buying the entire company, not just a tiny stock. You look at all its assets, right? How much money it could make, its earnings potential, everything. And then you kind of project that into the future, how much cash it'll bring in. Then you discount it back to today. Like, what's that whole business actually worth right now?
Ah, so he wasn't thinking like a stock trader. He was thinking like the owner.
Exactly, like a private owner.
Private owner mindset.
And there's this great story. It shows this perfectly. He invests in this company, Commonwealth Tresco, buys shares for $50 each. But his analysis, it shows those shares are intrinsically worth, get this, like $125 each.
Whoa, that's a huge difference to pay off.
Big time. He ends up selling those shares for $80 each,
Nice.
which was still, an amazing return, especially since the market price was way lower at the time.
Yeah.
So it shows that patience. He was willing to wait for the right price, even if it took years.
Years.
Yeah.
So patience, obviously. That and eye for value. Okay, that's clear. But his letters also, they talk about these workouts. It sounds more like something you do at the gym. So what are workout investments?
All right, so think of workouts as investments that make money from like specific things companies are doing, mergers, acquisitions, liquidations, that kind of stuff,
Oh, I see.
like corporate actions. So it's less about, is the market as a whole going to go up? It's more like, can I predict how these specific moves are going to play out?
It's like playing chess, almost.
Exactly, you're anticipating and then positioning yourself to, profit from it.
So that sounds a lot more risky than just like buying and holding a regular stock, right?
It is a different kind of risk.
Yeah.
You're not tied to the whole market going up or down. And Buffett saw this as like, a way to find opportunities that other people were missing. Like maybe a company's undervalued because of some temporary thing happening, right?
Gotcha. So can you give us an example? Like from the letters, what kind of workout did he actually do?
Sure, yeah. He talks about this play where smaller oil producers are selling out to the big oil companies, right?
Yeah.
Like it was happening a lot back then. So he'd analyze these deals, figure out who was going to benefit the most, and then buy shares accordingly.
So he had to like really get into the weeds of these deals to see how they'd play out.
Yeah, he had to understand the intricacies.
Okay, so workouts, that's fascinating. Now, he also had this thing about wanting control, not just being some passive stockholder.
Oh, absolutely. Owning a piece wasn't enough. He wanted to be in a position to, like, steer the ship, really unlock a company's full potential.
But that sounds like a much longer game, right? How did he go about getting that control?
Patience, again, and strategic buying. Like, he'd start with a small stake in a company that he thought was undervalued. But then over time, he'd buy more and more, gradually increasing his ownership until he could make actual changes. And that could take years.
Years.
Yeah, years to get to that point.
And that's exactly what happened with Sanborn Map Company, right?
Yeah. The perfect example. So Sanborn, they had all these amazing maps, like super detailed, incredibly valuable. But the management, they weren't really doing anything with them.
Yeah.
So the company was undervalued, and Buffett, he saw the potential there.
And so he just like took over.
Not quite a hostile takeover. He started buying shares, more and more, until he had enough to influence the board of directors. Then he restructured the company, figured out how to use those maps to actually make money, and of course, he profited big time. Like he turned a boring old map company into a success.
Now that's impressive. It seems like he could spot hidden value where nobody else could.
Absolutely.
Yeah.
And his strategy with Dempster Mill Manufacturing Company was similar, It shows how he blended patience, value investing, and that desire for control to like make these winning plays.
Yeah, Dempster Mill Manufacturing, they were, having some trouble, but Buffett saw something there, potential, especially in like their assets. They were worth more than the market thought.
And so he buys a controlling stake in the company, right? Gets in at a bargain. And then, in the letters, he actually spells out 3 big lessons he learned from that deal.
Okay, I'm listening. Lay 'em on me.
So first, he talks about the power of converting assets to cash. Like, you find a company sitting on something valuable, but it's not being used, right? You unlock that, bam, immediate value. Second, he talks about shifting a company's focus to more profitable areas. In Dempster's case, it was getting into securities, kind of like a side hustle with better returns.
Interesting.
And third, well, guess what? Buy at a bargain. He just hammers that home again and again.
Yeah, no kidding. It's kind of his thing, right? But hey, can't argue with the results.
No.
And speaking of things working out over time, the letters constantly talk about thinking long term and that whole compounding thing.
Absolutely. He was never about those quick wins or like chasing the latest fad. He talks about a 10-year mindset, focus on steady growth, let those gains build on themselves. That's compounding in action.
And that's where his famous Columbus analogy comes in, right?
Oh yeah, the one about compound interest. Imagine, he says, that the $30,000 that funded Columbus's voyage had been invested, right? Like a modest 4% interest, left alone for centuries.
4%, huh? So what, like a savings account, basically?
Yeah, pretty much. But the kicker is, centuries of compounding later, that tiny sum would be worth $2 trillion today.
2 trillion. Jeez. That puts things in perspective. Makes you think twice about grabbing that extra latte, huh?
Right. It really drives home that time it's your biggest ally in investing. But I got to point out, Buffett wasn't just blindly bullish on everything. He was actually pretty skeptical about those so-called blue chip stocks.
Yeah.
And he had this warning about new era thinking.
Blue chips and new eras. What did he mean by that?
So basically, he was saying, don't just buy into the hype. Even for the big, well-established companies, no stock is worth any price, especially when the market's all euphoric, everyone's over-optimistic. He had this saying, trees don't grow to the sky. Like, rapid growth, it doesn't last forever. And he was super wary of this new era thinking where people assume the market just keeps going up, 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 no corrections, no problems.
Huh. So even back then, he was sounding the alarm about getting caught up in the frenzy, which kind of makes you think, right, with how markets are today, it's a timeless lesson about keeping a level head.
It really is. Another interesting point is how he defined success. He wasn't just aiming to make money, he wanted to outperform the Dow Jones Industrial Average, consistently, especially when the market was down.
That's a tough goal. Why was that so important to him?
He believed that real skill, it's shown in navigating tough times, not just riding the wave when things are good. And he had the data to back it up. Showed how his partnerships beat the Dow and even those big mutual funds when the market was tanking.
So he wasn't afraid of a downturn. He saw it as a chance to prove himself. That's pretty bold, especially back then.
Definitely. And it leads to another key takeaway. He was adaptable, didn't stick to one approach, His strategies evolved over time. He even created 4 categories for his investments.
Right, the generals, workouts, controls. What were those again?
Okay, so he had generals private owner basis, generals relatively undervalued, workouts, and controls. Basically ways to classify the different opportunities he was looking for.
Like a spectrum of investments, each with its own, potential and risks.
Yeah, exactly. General's private owner basis was his classic value investing. Analyze a company like you're buying the whole thing. General's relatively undervalued. Those were good companies, trading below their worth, but maybe not the same control potential.
Okay, and then the workouts, those are the corporate chess moves we talked about. And lastly, controls, where he could really, steer the company.
Yeah. Right. So it shows his thinking expanding, not just about finding undervalued companies, but different ways to generate returns. And even with all these categories, his core principles stayed the same. Really understanding the business, long-term vision, and valuing a company for what it's worth, not just the hype. But then he drops this analysis of swap funds that were all the rage back then.
Swap funds. He wasn't afraid to go against the grain, was he?
Not at all. So swap funds, they were like this hot investment thing in the 60s. Rich folks pooling their assets to avoid taxes,
Sounds complicated.
Very. They'd exchange shares of different companies to get capital gains without actually selling.
Okay, fancy maneuvering.
But Buffett, always the skeptic, he digs into the numbers, compares their performance to the Dow, and guess what? A lot of these funds, despite the tax perks, they didn't actually beat the market over the long haul.
So all that complexity didn't necessarily mean better returns.
Exactly.
Yeah.
Keep it simple. Focus on the fundamentals. That was his message. And this leads to another interesting point. His view on taxes. He believed in paying his fair share, but also in minimizing his burden legally through smart investing.
Right, like that famous quote, I'm going to pay a lot of taxes, but at a very low rate.
Exactly. So it shows he wasn't just a brilliant investor, he was a sharp businessman too. Knew how to minimize costs, maximize returns. So from finding those undervalued situations to mastering the workouts, from thinking long term to questioning the hot trends, man, these letters are packed with insights.
Yeah, it's like we've been given this map, right, to like smart financial decisions,
Yeah.
but there's still so much we got to figure out ourselves.
That's a great way to put it. These letters, they give us a framework. They show us those core principles that made Buffett successful early on. But the real learning comes from applying those principles to our own lives, right?
Our own situations. So how do we do that? Like, are we all supposed to be out there hunting for these undervalued companies, trying to do takeovers?
Not exactly, no. The point is to understand the ideas, right, the principles, and then figure out how to use those in a way that makes sense for you, for your own investing style, your risk tolerance, all that. Like, you might not be able to buy a whole company, but you can definitely apply that same kind of analysis when picking stocks.
So instead of just following the crowd or like chasing the latest hot stock tip.
Yeah, you got to dig deeper. Understand the businesses you're investing in. Look for long-term value.
Look for that value.
Yep. Focus on companies with, strong fundamentals, good management teams, and like a real competitive edge. And don't forget, patience, patience, patience. It's a marathon, not a sprint. Buffett's success, it shows us that slow and steady wins the race.
Compounding. Right. And hey, what about those workouts? I mean, they seem a little more complicated, but they show us that there are always opportunities out there. You just got to be willing to do the research, think outside the box a little.
Absolutely. The key is to, stay curious, keep learning, adapt as the market changes. That's what Buffett did his whole career, never stopped evolving. Yeah, like his whole analysis of those swap funds, remember, he didn't care that everyone else was doing it. He went back to the numbers, focused on what made sense.
That's so important, that independent thinking, especially now when there's so much information out there. Don't just follow the herd. Do your own research. Think critically. Find your own path.
Yeah. And it makes you realize that investing, it's not just about picking the right stocks. It's also about, like, your mindset. You need that discipline to stick to your plan, right?
Right.
The patience to ride out the storms and the humility to learn from your mistakes.
Oh, yeah. And don't forget temperament. Buffett's success, it's not just because he's a good analyst. It's because he stays calm even when the market's going crazy. That emotional intelligence, it's huge for long-term success.
It's huge. Okay, so we've covered a lot, right? From the basics of value investing to the, mental game.
Yeah.
But it feels like we're just scratching the surface.
And that's the exciting part. This deep dive into Buffett's early letters, it's just the beginning. Now we've got this foundation to build on. So where do we go from here? Like, what can our listeners do to keep learning about Buffett and his approach?
Well, his later letters, the ones to Berkshire Hathaway shareholders, those are gold mines. They show how his thinking evolved as his portfolio grew, as the market changed.
And there are tons of books, articles, all about him, breaking down his strategies.
But don't just read about it, right? Put it into practice. Start using some of these principles with your own investments, even if it's just a small amount. Track how you're doing, learn from your mistakes, and adjust your approach over time.
And remember, the goal isn't to become Warren Buffett, right? It's to find your own way, your own investment philosophy that fits your goals, your risk tolerance, all of that.
Exactly. This deep dive, it's like a roadmap. But the journey's yours. So go out there, explore, try things out, and most importantly, have fun with it. Becoming a smarter, more confident investor, that's what it's all about.
That's what it's all about. All right. Well, thanks for joining us on this awesome journey into the mind of a young Warren Buffett. Until next time, happy investing, everybody.